Access to this webinar is educational informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders are discussed and tracked to monitor virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Either PhilStockWorld.com, PSW, North affiliates, and any respective offices, personnel, representative agents, or independent contractors in such capacities. Licensed financial advisors, registered investment advisors, registered broker dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach the risks and potential rewards of trading options. We are not a service does with trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not to bill and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to all the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing the webinar, you agree to be placed on a mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and will not distribute this other information anyway. Okay, thank you. Now we can move on. So what is going on? We haven't done this for a week or so, have we? I don't remember. Did we do this in California? I have no idea what's going on anymore. I don't even remember the last time we did this. I feel like I did it in California, but maybe not. I remember doing one that was short, but I don't remember where that was or what we were doing. Anywho, it doesn't really matter, does it? All right, so what's going on? Let's take a quick look at where the indexes look. Woo, look at that. 500 points up. Is that real? No, that's not today. This is all messed up. I'm like, what the hell? Oh, dear, oh dear. I'm like, that does not seem right. All right, well, on the screen, it looks like we're up 221. Let me see if I can get this thing back up and running. Relaunch. All right. Hang on a minute, gotta take this off. You should be back in 1 second. Gotta just get this log. Oh no, it's gonna update. Ugh, how annoying. All right, we'll get back to that in a few minutes. Hopefully everything's good. Let's go look at the futures instead, and we'll see how that looks. If I can find that, here it is. So actually, we're up 300 points, not 500 points. That would be crazy. And actually, this is really good though. We're at 1.3%. You know, it's offset by the dollar. The dollar's down half a point, but that's not really. You know, when you're at 1.5, when you're at 1.5% or 1.3%, it's okay. The dollars are helping, but it's not doing the whole thing. Europe is not really cheered up the way we've cheered up so far, but we don't know what's going to happen with the Fed in an hour. So that's what we're going to have to see. We're going to see what actually goes on and where things end up. So hang on a second. What does that say? It says pause. Show screen is paused. Hopefully this will work. Dun, 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 dun. What is that? Okay, I think it's working. All right, so hopefully you guys can see my Thinkorswim now. Now let's see what's actually happening in real life. Okay, so we're up 280. We failed at 2,400. That's not 24,000. That's not that great. ES is failing at 2,580. And 6,600 was not good for the NASDAQ, and 1,400, this is very bad. You do not want to see 1,400 becoming a rejection line on the Russell. And we have a lot of exposure on the Russell, so I'm very worried about that. I'm really not too happy about them not doing good. Oil, not 47.50 yet, but barely over 47.50. That's very sad. Gasoline, not even making, rejected at 140. Overall, this is just not that good. I gotta tell you, there's nothing very encouraging here. I mean, despite being up 300 points, it's not an encouraging way to be up 300 points, and we're losing those 300 points pretty quickly. So we shall see what happens. What have we been talking about today? Let's see if I can find PhilStockWorld. Here we are. All right. I was unfortunately not happy this morning as I was writing my thing. I mean, FedEx is look. We got to wait the UPS, but FedEx is saying massive sudden global slowdown, and that should scare the crap out of you. They're on top of the situation, okay? Everybody suddenly stopped shipping. They know about it real quickly. And, it's not a good thing. And the only not terrible thing about this is that, well, at least we could resolve our trade war with China, and things will hopefully get back on a little bit more of a positive path, but that doesn't fix Brexit. That doesn't fix everybody's debt. That doesn't fix the fact that rates are rising. That doesn't fix inflation. It fixes one thing that's a self-inflicted wound that we have, which is what I'm saying over here. It's it's a self-inflicted wound. We did something stupid, and now we're falling fast. That's what that cartoon's about. It's like just generally the coyote's modus operandi. It's like these are the unintended consequences that are pretty obvious in retrospect when you do something like start a trade war with when the first largest economy in the world starts a trade war with the second largest economy in the world. And it isn't just China, because we also started a trade war with Mexico and Canada, and God knows how many other countries Trump's beefing with right now. That's not good. How could it be good? All right, this is why I've kept so much money in cash in all of our portfolios, because we really didn't expect these massive gains to last on the stocks that we have. So unfortunately, now the portfolios are down quite a bit, but they'll recover their positions we want to own long term. But short term, I mean, the good thing is we have the cash flow, so now would be the time to take our lumps and double down on positions. But when we find a bottom and we see some real indication that things are going to stop going down, because we're not there yet, not by a long shot. This says Trump takes office, and it's hard to see, it's kind of flat, but basically we're almost dead flat to here. And Trump says he inherited an economic disaster where this was the economic disaster that Obama inherited from Bush. And Obama could have bitched about it when it was down here, and the market went from 8,000 to 6,000 at this point. But no, it recovered, and it went all the way back up to 18,000. That's a recovery. That is not at all what Trump had. Trump, as with his whole life, he got the ball on third base, and he thought he hit a triple, but he said he's still on third base. And we're out of batters at this point, so we're in big trouble. I don't know. I mean, look, I consider it encouraging that, although you think that, well, maybe that is what the market boost is about, but basically Trump backed off the government shutdown thing after that bullshit with Schumer and Pelosi, where he said, I'll shut it down, I don't care, I'll shut it down, blah, blah, blah. No, he's not shutting it down, because he can't. His whole party's like freaking out at it. But really what they're saying is they're like, if you want to shut down the government, do it when the Democrats are in power in a month. Don't do it now. Don't do it while the Republicans are in power. We look like idiots. So Trump will shut down the government over his wall. It's not like he's really giving up on it, but he's not going to do it under the Republican administration. So he's going to wait until the next meeting to have a shutdown. And he'll blame everything on the Democrats and say, it's those guys' fault. While the Republicans still aren't passing any budget with a wall in it. And they still have total control of Congress. Can't do it. Still not. You can't get enough people in his own party to agree. We talked about cannabis, which is I cannot tell you how much money is in this company, in this business. I was just out in California. I think the nearest thing I can compare this to is it's kind of like, well, maybe this is just me because I grew up next to a farm. There's a farm at the end of my block. There was a farm when I was a kid. I live in a farm country. I lived in Rockland County in New York, which is a suburb of Manhattan. But we had a farm because it was, there weren't that many people 50 years ago. And it was a great farm. We used to go there and get our old food. Like we'd always just go there and get whatever food was in season we would eat, which was great. But to me, it's like, so in my mind, we used to walk through the cornfields and there's always corn. And we would take the corn and farm and get pissed and chase us off the land and whatever. But we would always walk. There's always corn. There's so much corn. And that's what to me, that's what the pot industry is like. It's like selling an ear of corn for $50. That's how much profit is in the pot industry. We bought, PSW Investments bought a manufacturer called New Age, that's a medical manufacturer of pot. And we're increasing their capacity so that they can supply for the what's the word of it? For the consumer market, for the ordinary consumers. Because basically they've been specializing in medical. Now but their quality of manufacturing is amazing because they're medical grade stuff. So it's all pure and passes every possible thing. Because of that, under the new guidelines for health in California, they're the only manufacturer in LA County that passed the inspection. So probably the rest of the competition is still 3 to 6 months behind us on that. Not that nobody else is manufacturing, but not in LA County. There's only a couple of manufacturers. There's a huge shortage right now of manufacturers. So we can't possibly fill the amount of orders we have. And what we do is we take not the flower, not the part people smoke, the buds of the pot, but the rest of the plant. Like when you're done pulling off the stuff that people want to smoke, you're left with the stems and the seeds and all the other stuff. We take that, which is called biomass, and we process it into oil and extract the THC out of it. So yeah, you can get it out of the part people smoke, but people want to smoke it, so it sells for a lot of money by just being smoked. But the biomass is just junk that the farmers have left over after they harvest, and we're getting $10,000 a liter for that. A liter. It costs us about $4,000 to buy probably about 30 pounds worth of biomass, and we get that for approximately 100 to 150 a pound. So it costs about $4,000 to buy stuff to make the liter. Then we make the liter, it sells for $10,000. That's a huge markup. But I'm over there and I'm saying, well, so who buys this stuff? What do they do with it? And Ken, the guy who's the CEO, he's like, you don't understand. He goes, they take this $10,000 liter and you can make 100,000 5 milligram anything, a gummy bear or a strip or whatever, 5,000, you can make 100,000 doses out of a liter, which is insane. So, because it's concentrated THC, when they have these things that say 5 milligrams is basically as much as you're going to smoke, or well, 10 is a lot and 5 is a normal amount for like a person who's not a heavy smoker. So 5 milligrams is fine. And if you have a gummy bear, you would have like 1 gummy bear with 5 milligrams of THC in it. Anyway, so they can make 100,000 of these gummy bears, or strips. Our guys use strips, which are like the things that melt in your mouth for your breath. You put them on your tongue. So when we manufacture them, we sell them for $1.25. So we make it so that $10,000 liter turns into $125,000 worth of product. That's wholesale. Then the place that sells them sells it for $2.50. So they'll mark it up another 100%. So it's marked up at that. So we take stuff, we make double, or more. We make 150% on our processing. Then the retailer makes 1,000%. Not the retailer, sorry. Then the manufacturer makes 1,000%, which we're manufacturing those too. And then the retailer then makes another 100% markup on the thing. It's unfreaking believable. And in the end, though, the consumer's only paying $2.50 for 5 milligrams, which is really nothing. If they have the gummy bears, it actually works out to $1. So it's actually very cheap to get high. I mean, compared to drinking a 6-pack of beer or something like that, it's cheaper. It's less calories as long as you avoid the pizza. So it's a crazy business. But anyway, so we're looking at Tilray here. They're the Canadian pot company. They just made a deal with, and again, it's, you got to get this thing about pot being something bad out of your head, because this Tilray just made a deal with Novartis to supply them with CBD, which is another byproduct of the process. That's CBD is a cannabis oil that's not psychoactive. So there's THC and CBD, and actually we get both out of a batch. So we can have a liter of either one, or a bit of both actually. So Novartis and Sandoz are buying the oils from these guys. That is massive, massive, massive amounts that they're going to sell all over the world. So it's huge. And these guys are supplying it. So we can't make that deal because we can't ship interstate. We can't, they're shipping out of the country. They can send a boatload of product to, from Canada to Germany or whatever if they want to. We can't do that. We can't even send it. We can't even ship out of California. We can't even cross the state line of California with that stuff. It's not federally legal yet. When it is federally legal, though, you're talking about massive, massive profits, massive values. It's just going to be a huge business, worldwide, massive, massive business. And I noted that, marijuana sales in the U.S., $6 billion legally last year. Going to be $20 billion in 2020, so it's going to go 6, maybe 12, and then 20 or whatever, or 6, 9, I don't know, whatever it's going to be, but it will go 6 something and then 20 in 2020. But you have to look in context to that, and that's legal, by the way. There's still plenty of illegal sales. This is only the legal sales. As the legal picks up, the illegals die. But we're not even eating into any other market yet. We're just eating into the illegal market. But meanwhile, tobacco sales, $100 billion of cigarettes in the U.S., $250 billion of liquor in the U.S. And that's your competition. And like I said, when you think about it in that terms, and smoking cigarettes to me is a different thing. You're not getting high off a cigarette. You get that constant nicotine fix. Marijuana doesn't do that for you. It's not a nicotine product. It's actually not addictive. But you do get high, which is not very different from being drunk, although it's it's different effect. But the point is, conceptually, you're going to get drunk, you're going to get high, whatever. A lot of people do both, of course. So that's your real competition. Is when you look at that compared to liquor for $250 billion, and you can either drink 6 beers and feel a buzz and go out, or you can have 1 gummy bear and feel basically the same kind of buzz and go out. And you will not be hungover from the gummy bear. So, so it's a lot cheaper, which is really why they outlawed marijuana in the first place, because there was no reason. Nobody's going to go from marijuana, which everybody smoked back in the day, in the old days. Nobody's going to go from that to liquor and spend 10 times more money on liquor unless you made the marijuana illegal and gave them no choice. That was the whole point of making it illegal. It was a huge business, but it was too easy to farm, too easy to make. There was no way to monopolize it, so they outlawed it basically. So that was worth noting this morning, because Tilray here has a $7.5 billion valuation, just $20 million in sales, no profit. In fact, this year they're going to do 40 million in sales. They're going to double from last year, 50 million loss. New Age, our company in California, is going to hit 40 million in sales in the upcoming year. They're going to make $10 million on it, because we're not idiots. we're expanding in a smart way. I'm making sure, we got our eye on the ball. That's what I was in California for last week. We're like making sure we have a business plan, we're sticking to it, we're making our profit, we don't get off on side tracks. We're doing everything we can to make sure that the cash flow is there so that we look better than all these multi-billion-dollar companies when the US finally goes federally legal. So that's good stuff. Seriously, you got to look at this industry, though. It's going to be the biggest. It's a chance of a lifetime to get in on something that's going to explode and become a huge industry. And it's right at the ground floor. And because it's federally still illegal, people aren't getting into it. People still look at it like it's not right or something. And the reality is, it's going to be huge. It's going to be it's going to be as good as liquor as far as morally or whatever for selling. Once people get over their prejudices about it, it's going to be the same as if you say, oh, I have a small beer microbrew or something like that. That'll be about the same level of people thinking you're a terrible person for having it. It's very interesting. The growth is astounding. And the funny thing is, you must never meet anybody in this business that isn't making money. You have to be a real idiot not to make money, or a public company like Tilray that's spending so much to expand that they're just blowing through cash. And for good or ill, maybe it'll work out for them, maybe it won't. But we're doing it the other way. We're saying, let's make money, then we do something to make some more money, then we do something to make some more money. The oil inventories, crude oil down a tiny bit, but not much. Gasoline up a bit, but not too much, and distillate's way down. So that's a net positive, but we didn't get a big bounce off of oil overall. We shot up there, but now we're drifting, and Brent oil didn't do anything off of that news. Gasoline came back a bit. Coming back to 140 is pretty good. It was at 134 yesterday, so 140 is actually pretty good. Natural gas has got clobbered and stayed down. I like natural gas down here. If we hit 350 again, it's a good buy. But doing this on a weak dollar is not impressive at all. Elon Musk news: SpaceX canceled their launch because they got problems. Micron got downgraded, but I think calming down a bit. GE doing very nicely, holding up. Hanes brand is doing terrible, totally crashing through the floor. But we actually we made a couple of moves here to improve our position on Hanes brand because we're sticking with it. FedEx is total disaster, but as we said, but this is very investable down here. What else happened? And as I said, we're into the Fed now. The Fed's coming up in 25 minutes. Very important. And we are up at 25.72, and the low a week ago was 26. So we're barely, we're right around this line. And this may be the new normal. I think I said 26.40. If we adjust the big chart and adapt it for the tax breaks that are a fact of life now, this is probably going to be like the 10% line on the S&P. So we're right where we should be, really. If it's not bearish, it's just sort of like drifting along. It's only bearish compared to the idiocy that we had where we were up so high. But if we settle down here, it's perfectly fine. It's a real good, strong market. And it's a problem when you get up too much. It's so easy to come down and look bad. Not one question. Wow, I must be so fascinating. Okay, cool. I'll just ramble on then. I got to ramble on. Only got a little bit of time till the Fed. So nothing going on there, nothing going on there, nothing going on here. Very boring. Okay, good. Boring is good. So let's talk about our positions and see how screwed we're going to be if things don't improve. Oh, I wish you can get that back. Darn it. There was 83.6% the last time I was on this thing with the long-term portfolio, and I guarantee you it's way lower than that now. Ooh, 200, no, that's a different portfolio. It's a short-term portfolio. The long-term portfolio is, dun, 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 70%. So we've lost 16% It's a $500,000 portfolio, so that's like $80,000. We've dropped $80,000 since whatever the last time we did a webinar off this computer is, which I guess is a couple of weeks ago. I think it was right before I left for California. So this portfolio is down to $80,000. The short-term portfolio is up about 50. So on the whole, they're doing what they're supposed to do. They balance each other out somewhat. The problem is, though, that in the short-term portfolio, we removed our TZA hedge a little bit too early. So now, where is TZA? So now we have a lot of TZA short calls. And TZA has kept going up. So we are going to be very, very screwed if the market does not start improving. So TZA is the ultra short on the Russell. I thought it was going to bottom out at 1400. It's right now a bit below the 1400 line. And that means that effectively the short-term portfolio is no longer protecting the long-term portfolio because it's pretty much neutral right now. Because what happened is we made a lot of money on the TZA longs. I wanted to take that off the table because I thought we'd get a bounce. We did not get a bounce. And so now we effectively don't have a good hedge against the long-term portfolio. So we have to be very careful what the Fed says here, and we're going to have to make a decision as to how we're going to protect ourselves if whatever they end up doing is taken badly. So, that's my main focus right now is we got 25 minutes to see what we're going to do. Now, obviously, what we're going to do is we're going to add a TZA call and see what happens. So, but we're going to have to add a lot. We're going to have to add a couple of hundred at least. TZAs, and I guess they would be January's. I don't know. I hate to do it. I hate to pay the kind of money that you have to pay to jump into TZA again. I really don't like it, but we're not going to have a choice. I don't see any other way to do it. What we're going to have to do is basically reestablish the spread that we used to have, which I think was the 10-15 or the 9-15 spread in 2020. But those calls are, I cannot get my head around doing that. I just don't, it's what you have to do, but I don't like it. I'm not enthusiastic about it at all. TZA, because you're talking about the January 2020, let's say the $10 calls, they're $5. The $9 calls are almost $6. There wouldn't be any point. They're $5. These guys are still, they're 5, 4, nope, 5. So it would be the $10 calls 5. That'd be $100,000 of our cash. Now, of course, we have a ton of cash because we sold the old calls, and we're not going to really be net. It's not too terrible out of pocket or anything like that because look, we're sitting on $462,000 worth of cash. But why do we have $462,000 worth of cash? Because we sold these calls. We sold these for 31,000. We sold these for 6. We sold these for 13, and we cashed in our long calls with a profit that essentially offset these losses of $70,000. So it won't kill us. All it's going to do is cost us $100,000 of our cash, and we'll be down to $360 in cash, which is still the full portfolio value in cash, and then we'll be back in reestablishing our hedge. So that's what we have to do if the Fed doesn't cheer up the market. We can't leave this open and bearish like that. That's crazy. I'm sorry, bullish. We can't leave it open and bullish like that. That would be insane. And we may have to add an additional hedge after that because we are right now. That goes to the options opportunity portfolio too. We are not in any way, shape, or form bearish enough for another leg down. And I'm sorry if I was wrong, but I really thought that the Fed had one more save in them. And I don't, I'm going to be very sad if it doesn't work out. So the LTP is down to 70%. We can live with that. I mean, obviously being up 70% for the year is crazy anyway. The butterfly portfolio I know is getting slammed. It's down 16%. Because we don't have any hedges in the butterfly portfolio. And worst of all, though, look at Apple. Apple is single-handedly killing us. Minus 23, minus 14, it's minus $37,000. That's 40% of the portfolio So that's basically the entire loss of the year is resting on this Apple here. OIH isn't helping either. That's also horrible. So, we played it bullish and it didn't work out. So that's not good right now. Money Talk is supposed to be the best balanced one, and we didn't mess around with that one. That's still up 85%. So we would have been better off leaving the LTP and the if we had left the LTP STP alone, and if we had left the opportunity portfolio alone, they would have held on pretty good, because I think these guys topped out at right about 95% or 100%. So they lost 15% during this market turn down, which isn't bad, and they're still obviously holding on to a tremendous gain. And the OOP is probably down to 20, right? 27 is not bad. They're down to 27. They were down from 40, so they lost about 14%, which is where it would be. But we've got these naked TZAs. There they are. We have 50 naked short TZAs. Now, they're not terrible. We lost $8,600 on it, but it sucks to lose $8,600. SEO is also killing us, by the way. We have these SEOs, and oil's not coming back, so we're getting killed on those. Apple, of course, getting killed on Apple puts. I mean, we got some big holes in this portfolio, but if it turns around, it's going to make a fortune. It's just right now, we're just sort of struggling. So that's a bit of a shame. Stop that. Pick time. Go away. Okay. And still no questions. All right, so that's a review. So that's what we're doing. We've got 15 minutes until the Fed, and all we can do is wait and see, which is what I said all week, though. It's a watch and wait kind of thing. What are you going to do? You've got a major policy decision coming up. Also, we have the GDP is going to come in on hang on a minute. Briefing.com. Log in. Calendars. Oh, on the economic calendar. So this is not a big GDP report, but we do a GDP on Friday. It's the third estimate of the of Q3. So they've already done two estimates. So it's unlikely to vary very much from there. But also the Fed is probably going to release their view on the economy. That's more worth looking at. And we're not going to get that from the minutes today. We're going to get more information on Friday from what they see as far as the numbers that are driving the decision they're going to make now. Today is the 19th. So we have the rate decision here. Then Powell speaks. That's more important than the decision is what Powell has to say. Tomorrow, we got the Philly Fed. Leading economic indicators have been very weak. The personal income, that's already, this is all Friday. Friday's a big day. Personal income spending, PCE prices, durable goods, GDP, huge day today on Friday. So again, whatever happens today will be one thing, but then we're going to get a lot of data to look at into the end of the week. So let's think about it though. Philly Fed, not likely to be anything exciting going on over there. Leading economic indicators, not something that changes very easily. And there's been no indication that anything would change beneficially right now. Personal income, that's been going up, but whether that's considered a good thing or a bad thing is a question. It's bad for companies when personal income goes up, but it's good for people. Personal spending, if this drops off, we're in trouble. But it's still bad because when people spend more, like, here, personal income 5%, they're spending 6%, personal income 3%, they're spending 4%, or point, whatever. If people are spending more than they are earning, if their spending is going up faster than their earnings are going up, that's bad. And that's why you have this chart that I was worried about this morning, which is gone. Here it is. That was what I started off talking about this morning. As I said, you got to look at this. This is a very, very bad thing. This is a personal savings rate. The personal savings rate, you should be saving roughly 10% of your income. A rational person would save 10% of their income. If you save 10% of your income for 40 years, you should be able to generate you should be able to generate your annual income for the rest of your life after you retire. That's the rule of thumb. Now, it doesn't work so well in a low rate environment, but at least it's something. And again, I stress this as much as I can because I want people to understand what we're doing here. Compound rate calculator. So if you are making, all right, so let's say you're making $50,000 and you put $5,000 away. Okay, and every year you put another $5,000 away. And for 40 years, you make 4% on that money. Okay, so at the end of 40 years, you're going to have $518,000. All right, so at 4% is not enough because 4% of 518,000 is only $20,000. That's saving 10% of your $50,000 income at 4%. That's why low rate environments are terrible for people. That's why the Social Security system is going bankrupt. You can't have 10 years where you make 2% on your money. You can't afford that. You can't live like that. But now, if it was 6%, a whole different ballgame. 871,000. 6% of 871,000 is $50,000. If it's the 8% normal market returns over 40 years, you would have $1.5 million, and your retirement income, if it's 8% of $1.5 million, is going to be $120,000. That's the difference the Fed makes. So when you sit there and you talk about, depending on where you are in life, but when you sit there and talk about, oh, the Fed should keep the rates low, no, they shouldn't. You know who wants the Fed to keep the rates low? Rich people like Donald Trump. And you know why they want the Fed to keep the rates low? So the poor people can't catch up. You will never catch up at 4%. We're not even getting 4%, we're getting 2%. There's not even a point in putting the money away at 2%. What are you going to do? You retire, you've got $300,000 when you were making $50,000 a year after saving for 40 freaking years. And if you had that much money, you would have more money than, oh, that was another chart I did this morning. See, I see, let me tell you something. I have very deep charts. I have very deep discussions in the morning. Look at this. If you have $300,000, you are in the top 90. You're in the up to the 98th percentile. Unless you're in the top 1%, you have more money than anybody in the country. If you have $300,000 put aside for retirement. That's sick. This is a big problem. They talk about, you talk about the crisis of Social Security, but you have to think about the crisis. It's not so much that Social Security is going to go bust, it's that nobody's prepared for it. Here, this goes up to 80%. Okay, so this is the bottom 80% of the people. Median households with median incomes, average savings. So the average savings for 80% of the people, for people, not 80%, for people in the 60 to 80% range, they're $148,000. Below that, $80,000. You can't retire on that. There's not even a chance that you can retire on that. That's what the crisis is going to be. It's not just that all these retiring people will strain the system. It's that all these retiring people are unprepared to retire. So now you're going to have millions and millions and millions of broke old people. And we have no plan for this. We have absolutely no plan for this whatsoever. We have skyrocketing medical costs. We have a collapsing retirement portfolio. We have companies and pension plans that are underfunded. We have zero plan whatsoever for what's going to happen when every single year for the next 20 years, 10 million more people retire with not enough money to live for even 1 year. What are we doing with those people? There's no plan at all. And that is why the rich people in this country don't give a crap about what happens, because they're all getting out. That's why they want lower taxes. That's why they want to keep more of their money. That's why they want these gains of the dividend incomes and all that stuff, because they're all cashing in and getting out of the country. This country is going to be a disaster. It's going to be just like Greece. It's going to be like, well, either we cut back on everything and try to bail out the people, or we default on our debt. So we do. There's no good answers. Or we tax the crap out of everybody. I mean, there's really, what are you going to do? How are you going to fix this? So what they're doing right now is they're taking and taking and taking all the money out, and they're looking for, and they're going to move to other places where the countries haven't completely screwed themselves up, like New Zealand. New Zealand seems to be very popular with rich people I talk to. They seem to be all going to New Zealand. But I think, to some extent, there's a falsehood to that. I think people think that just because they don't, New Zealand's on the other side of the world. And people like it because they speak English, and it's comfortable. It's like the same kind of things we do generally, but because it's on the other side of the world, you assume everything is fine there just because you don't hear about problems or whatever. I don't think it's the best solution. I think Canada is a much more realistic solution. They've got a much more empty country, a lot more resources. Global warming is actually beneficial to them because it's going to warm up their country. So Canada and Russia are going to do quite well with global warming. Scandinavian countries are attractive. I've been looking at the Isle of Jersey, which is in the Mediterranean, off the coast of France. But you got to have a plan. You got to have a plan for where you want to live if America falls apart, because it's not outside of the range of possibility. We've really made a mess here, and what Trump has done has made it much, much worse, because it's a kind of problem that needed to be dealt with, and instead of dealing with it, we went the opposite way, and now we've made it much, much worse. And it's all coming to a head. The demographics cannot be stopped. These people are hitting retirement age. I'm a baby boomer. I'm a tail end baby boomer, and I'm 55. So 10 years from now, I'm going to be one of the problem people. My people in the top of the baby boom, the early stage baby booms who were born in, let's say in the 50s, people born in 1950 are now 68 years old. They're retiring. This is the beginning of it. And it's going to be a decade of this stuff ahead of us. So for a whole decade, 100 million people over the next 10 years are going to retire, and based on life expectancy, they're not going to die. They're just going to put more and more and more and more and more strain on the system. And it's not just a strain on the system. That's the problem. Everybody just looks at whether or not Social Security is going to hold up, whether or not Medicare is going to hold up. That's not the point. They don't have money to buy food. They don't have money to pay rent. They don't have money for nothing. They did not save that money. And the last 10 years have put a nail in the coffin, because there's been no way that whatever money you had as of 10 years ago gathered anything. And also the market crashed, so it took away some of the retirement money anyway. Total disaster. So that's what we're heading into. So there you go. Time for the Fed. Anyway, don't want to be a downer, but really, you have to think about this stuff. John says, thanks for the horrendously depressing savings rate future discussion. Is it too early to go to the bar? No, it is not. It is never too early to go to the bar. This is why you have to invest in marijuana stocks. Okay, it goes back to the same thing. It's like you really want to be stoned for the next 10 years. It's not going to be fun. Rob says, Phil, when you leave the country, where will you go? What country do you like? My favorite place right now is the Isle of Jersey, which is a British protectorate. They're not part of England. And so they're not affected by the Brexit nonsense. They really have their own deal with the EU. And they're protected by Britain by the kind of contract that's like, you know, an unbreakable contract. You know how England is. They're not gonna like let their island go. But they're an independent nation. They're a tax exile. They're a place of tax exile, mostly filled with very rich bankers and farmers. It's a beautiful island off the coast of France. Let me see if I can show you. Isle of Jersey. Hang on. Zoom out a bit. See, here's a place called Guernsey, and here's Jersey. They're both in similar situations. So they're under British protection, but they're their own place. They bow to the Queen though, but they've got their own governorship and their own independent everything. So they're close to France. It's very short. You take a ferry here, you take a little private planes, and you get onto France. And then once you're in France, of course, you can go anywhere you want in Europe. It's very temperate. The weather's great. They're self-sufficient. They're all farmers. It's a farming island. It's not that big. It's probably it's not that small, but it's not that big. You know, what is it, like 34? Well, you can see the scale, 20 miles. So it's like 20 miles by 10 miles. Not huge, but very upscale. They've got, you know, they're all. It's a banking area, the banking tax haven. So basically, it's got everything I care about as far as financials, access to Wi-Fi, the kind of people I want to talk to, and so on and so forth. And it's out of the way, so I like it. I mean, and also again, you don't have. Here's your wall. You know, every Trump walks a wall. Here's your wall. It's not that easy for people to come and annoy you. So that's a good thing too, because that's something you have to consider. When people start going broke all over the place, they're going to be looking for places to go. And this is a bit of a stopper. It's not like a casual beggar is going to come over and ask you for spare change. So I like that a lot. I do like that island. Other than that, though, I think, and again, I mean, if you're looking long term, it's, you know, when I think of a place to live, I think of a place to live where I'm going to make a home that eventually my kids might want to live in. I want to build up assets. I'm going to want to start a business there. You know, I can't just sit around. I'm not going to sit around. So I look north because, again, global warming, you have to take it seriously. A lot of these places are going to run out of food. Everyone down here is going to run out of food. Everyone down here, they're going to turn into like a desert eventually. Not right away. It doesn't have to be right away to have like a 1930s Dust Bowl situation where things just, you have a bad couple of seasons and everything turns to crap. So you want to be a bit more north, and you don't want to be too close to the ocean, or certainly not in low-lying land too close to the ocean. But like, you know, Norway and Sweden should do very well. Canada's a good place. Iceland is actually interesting, but it's, again, you know, it's like, you know, to live now though. It's like, you know, you got to balance that with, do I want to live there now? It's like, no, I don't really want to live in Iceland now. But you know, Canada is really nice. I like Canada a lot, and it's certainly on my list still. I'm thinking about Toronto actually. Sweden, Norway, very nice. I'm not a fan of Finland. Just it's a little more rural. Russia is going to be good. Russia is going to be in great shape. I mean, this whole Putin loves this. Putin laughs his ass off. Global warming turns this into farmland, and it turns this into like an ocean that he can actually use to get anywhere he wants. So Russia is absolutely in love with this whole global warming thing. Oh, Fed time. All right. WSJ. I'm not going to even attempt to. Fed raises rates. Ha! Good for them. Good on you, Fed. Hang on a second. They raised it a quarter point, and apparently they've also said that they're kind of done. They're going to raise maybe twice more next year. Oh, here you go. Good. This is just what they should have done. Fed decision. What? Live coverage. Yeah, where is your live coverage? Seriously? Hey, Wall Street Journal, try not to be so lame. Seriously? Twitter, save us. FOMC. I bet somebody's got something up today here. Ivan said, if I showed you an advanced copy of the Fed statement now, would you know how to trade it? Well, I think initially, obviously, people don't like any kind of hike, but I think on the whole, it's the best thing they could have done. Fed meeting in Washington, Federal Reserve issue statement. All right, let's just take a look at it. Nobody seems to be analyzing it, so I'll have to do it. It's not long. All right. Information. All right, Steve. The bottom line is they're now saying that there's only going to be 2 hikes next year, so that's half as many hikes as people were thinking. So they raised the rate, but then lowered the expectation going forward. So they're messing around with the yield curve as much as they can. At the moment, I see the Dow drop pretty sharply. Oh, everybody's dropping sharply. I don't see the point. I think this is fine. I don't know. There's nothing I would panic out of. Information received indicates the labor markets continue to strengthen, economic activities rising at a strong rate. Job gains have been strong, unemployment has remained low, household spending is growing strongly, while growth of business investment has moderated. I don't think it was rapid in the first place. On a 12-month basis, overall inflation is other than food and energy remain near 2%, indicates long-term inflation little change. Consistent with the mandate, the committee seeks to foster maximum employment and price stability. All right, now, especially with oil prices down so much, there's no way we're going to have any inflation. So there's no danger to keeping rates low if you don't think there's going to be inflation. The committee judges that some further gradual increases in the range will be consistent with sustained expansion and strong labor, blah, blah, blah. And the committee risks the economic outlook of balance, but will continue to monitor things in case blah, blah, blah. In view, they've decided to raise the fund rate and determining the size of future adjustment target range for the fund rate. They will assess blah, blah, blah. It's the same thing over and over. There's nothing to this now. Okay, so they raised it a quarter point and they lowered their expectation of future raises. And let's see how everybody's reacting to that. Not you. So refresh. Oh, hourly. Nope, 5 minutes. Oh, so I guess it's delayed. All right, let's go to the this thing. Charts. Wow, look at that. Well, that's interesting. Oh, that's TZA. That's the worst thing that could happen for us. So TZA popped up. Get the Dow YM. So look at the Dow, 24.1. What? You were not. It was a 24.1 and now it's a 23.8. 300 points. Wow. This is such an overreaction. Wow. Okay. And oil too. Oil's failing. Brent's failing. Gasoline failing. Everybody hates the fact that they hiked. Wow, the Dow is now almost negative, up 27. I don't know what this is. The futures. Futures are not getting hit as hard as the straight up Dow. Straight up Dow is the futures almost flat. I mean, the straight up Dow is almost flat. The NASDAQ is red. Wowie, kids. But anyway, I don't consider this a bad thing, and I think that in retrospect, I don't think anyone's going to consider it a bad thing. I like this line here, 2550 on the S&P is kind of a fun place to take along. 6,500 obviously on the NASDAQ. If we're over 6,500, I like that for a long line too. I'm not going to play any futures now because I just think it's a little too violent. But that's where I think the play should be. 6,500 on the NASDAQ and 2550 on the S&P. And I guess 23.7 over here also. This guy wouldn't touch this. Russell's been terrible. But that's where we are. So we'll see if that holds up. But this is just silly. I mean, the sell-off is ridiculous. For a quarter point hike, when they lower expectations, it's ridiculous. Can you go over TZA again? How do you size it to your portfolio? I think there's more negative short-term. Would you look at the April 14, 17 bull call spread for 75 for some portion of longs? Look, TZA, you can use that. There's nothing wrong with it because for 75 cents, if we hit 17, you're going to get back $3. It's a great return. That's the kind of spread you do want to be in. But you have to keep in mind, though, when you have a tight spread like that, and it's way out in April, unless we're still down in April, you're not going to get paid. Even if the net of the spread is not going to change very much the entire time you own it until you get into April and the premium starts wearing off. So unless you expect, you say short term, unless you expect the Russell to go down and stay down significantly from where it is, because it's not even at 15 yet, unless you expect it to go down and stay down from here, and you need a $2 move. You need basically a 20% move. No, I'm sorry. You need a 20% move, practically a 20% move in TZA, which is going to be a 7% drop in the Russell, which is maybe about 200 points. Is that right? That can't be right. What's 7% of 1,400? Well, 10% of 1,400 is 140. So call it 100 points. Sorry, so 100 points. So, you know, you're looking for another 100-point drop in the Russell to get paid. That's a lot. I mean, it's possible. Obviously, we just dropped freaking 25 points right now. I mean, so I don't want to say anything's not going to happen. The way this market's reacting is they were just looking for an excuse to sell off because there's nothing in the Fed thing that was too surprising. I would have been more worried if the Fed didn't raise rates, because that would indicate that they're more worried than I am about the economy. They're raising rates saying we are staying on our path. Nothing has changed. And what they're saying here in the subtext is you guys are all overreacting. This market sell-off is silly because we're not seeing it in the data. And you know, and again, it goes back to will we or will we not fix our trade war issue with China? Well, that's really the wild card in this thing. And unfortunately, the president's a freaking psychopath. So you can't believe anything he says. China's Z yesterday was very hard line, saying China's not bending to you sons of bitches. So they're not anywhere close to making a deal. Excuse me. And that's what it's all about. That's where this thing is resting, is whether or not we have a trade deal with China and whether anything happens. So, you know, look, as a person who's on the wrong side of things right now, as far as TZA goes in the portfolios, I'm not dying to cover unless we finish at lows. If we finish at lows, I have to cover. Like I said, have to. And again, we're only spending money that we already got on the long side. But on the other hand, I'd so much rather make that money on a bounce. And what the Fed did to me doesn't warrant this kind of sell-off. So I think I would much rather wait until Friday and get better information from the data. But then there would have to be a strong indication that there's a reason to be bullish, because otherwise, you know, you gotta lean towards caution. Otherwise, Rob says, Phil, you mentioned you're creating a cannabis fund. If we believe in this industry, can we get involved with your fund? Yeah, it's going to be like a hedge fund, except specifically for cannabis, because we have to have this very flexible sort of format, and a hedge fund seems to be the best sort of structure for it, because it's tricky if we run it. You know, we can't run it like the VC company, because we're gonna take stakes in a lot of companies and have a lot of stock in various companies. So it's going to be like a pre-IPO hedge fund sort of thing. Anyway, so yes, we're going to raise probably, I'd say a minimum of $20 million in July, and as much as $100 million. If everybody tells me they want to invest, we're going to have $100 million. Probably the minimum is going to be 250, maybe 5, it depends. Depends how many people and how much money and so on and so forth, because we really can have more than, I think, 100 members, maybe 200, I'm not sure. So depending on how the money comes in, we can't have if we allow too many people with too little money, it messes it up. But anyway, if you want to find out information about it, it's going to be 6 months from now, but we're working on it. We certainly want to talk to people now. Contact Greg at PhilStockWorld.com. And Greg is the admin, and he takes care of all that stuff. So we'll get you on the list, and we'll let you know as developments come and so on and so forth. Also, you'll have to qualify. You have to be a qualified investor no matter what. So that's going to be very important also. The forms have to be filled out for us to be able to have specific discussions on it. But that's the gist of it, is what we're doing. I'm very excited. I mean, I cannot believe the opportunity in this industry. It's unbelievable. How far above sea level is it planning on a houseboat? Jersey is above sea level. It's sort of a raised island. Should be good. Yeah, I don't think if for the next, I mean, for 100 years, the sea level is going to go up a few feet. That's not, in Florida where I am now, it's going to be devastating. I don't have a few feet. And as somebody mentioned in chat, I think Pyre mentioned in chat, it's not just whether or not your house is underwater, it's whether the water table is underwater. Because once you get salt in the water table, you're dead. Then you have an uninhabitable place. It doesn't matter what you do. Nothing's going to grow, and you can't drink the water. So you got to leave. It doesn't matter if your house is still dry, so what? So nasty, nasty. And wow, what ugly, ugly turn in the market. I mean, Dow's now down 50 on the big board. Oh, and Brian's got a link. Well, I like that, Brian. Let me see if I can somehow use that. Thank you, Brian. So we'll see what changed, which I think is, probably a lot. I mean, it's a very different kind of statement than they made last time. Maybe I'm crazy. So here's what changed from statement to statement. No, really? I'm surprised. I thought it was a bigger change. Okay. So all this bullshit was the same, and all they really said was the committee, instead of saying expect, they judge. So in other words, they no longer are sure, but they think there will be further gradual increases in the range. So they're obviously having some arguments. They're leaning back less bullish, less hawkish than they were. Here they said, originally they said risks to the economic outlook, and now they're saying the committee judges at risk to the economic outlook up here are, this is interesting, it's a weird change, isn't it? The committee judges at risk to the economic outlook are roughly balanced versus risks to the economic outlook are roughly balanced. So effectively they added the committee judges. That's the only change. So they added the committee judges that, and everything else is the same sentence. Isn't that weird? And they changed appear to are. So I guess that means they feel more sure, but then they put in judges. They went from a definite statement to a judge. But now here's a whole change. But will continue to monitor global and financial developments to assess their implications for an economic outlook. Okay, not that helpful, really. Wow, I mean, that's way. I didn't realize that the statement last time was in that light so much. So think about that. So effectively, it's the same statement they made last time, and the market's going to sell off on that. That's stupid. So I reiterate my call for the longs. I do not believe that this is warranted, this sell-off. And we've already had a massive sell-off. So again, we're looking at 25.50 here. We're looking at 23.7 here as a long. We're looking at 65 as a long. Well, okay. So anything over those lines is a good spot to go long on these things. I think this is a big overreaction. We'll find out into the close, but to me, it seems like an overreaction. All right, so what else do we want to talk about? What's going on? I guess you can take a look at some of the stocks. We did our portfolio review. I didn't consolidate the review, so it's Wednesday already. Oh my God. All right, well, I guess I should do that. Not now, obviously, but I mean, at some point. Let's see where we were in the long-term portfolio. Wednesday. Home. Market Friday. Okay. Oh, see, we're at 840. All right, so we were 847 on Friday, and now we're at 852. So we haven't changed. That's not bad. Nothing's changed since Friday, really. So I'm fine about that. All right, we're balanced. We're okay on long-term portfolio. I'm surprised. I thought we'd be down a bit more than that, but we're not. Here we go. So we're down $80,000 since the last review, but not particularly hard hits for the week. And I wrote here, I mean, this is stuff this is what I'm talking about. I said the same thing. It's loss mitigation. You're not supposed to be, the short-term portfolio is up $68,000. So, you know, together they're barely changed. And that's the idea. It's like, so one went up and one went down. That's what they're supposed to do. The problem we have is that now, at this point last week, we decided to get much more bullish playing for a bounce. And because of that, we've now exposed the short-term portfolio to damage from the Russell. And if the Russell keeps falling, the short-term portfolio is going to take a hit. But I still haven't got, based on what I just saw there's no change from statement. Thank you, Brian, that's important. There's no change statement to statement from these two, from the Fed. The Fed hasn't changed their stance at all. Nothing has changed. We're still in a trade war with China. Everything is still the same. The data is still coming in weak, but okay. It's not that terrible. It's not worth this kind of sell-off. I mean, it's worth the sell-off we had. I'm not saying we should be much more up than here, but we shouldn't be down more than here. And that means that because the short TZA calls that we had left, don't think we cashed in the long calls and took a profit. That was more than the profit we would have made on the spread. So assuming TZA stays where it is, in both cases, the short calls that we sold will lose their premium and make us even more money. And that was the idea. In other words, I said we're done going down. And so far I've been wrong, but that doesn't mean I'm wrong. It just means so far I've been wrong. So if we look at the day chart, well, let's look at the hour chart from last week. So last week at 1420, I said we're done going down. And here we are at 1375. It won't matter if we hit 1375. If we go back over 1420, I'm right. Because it wasn't a one-day move. We're not doing it. It wasn't a day trade. We're doing it into next month and the month after that. You know, these short calls are January and then April and then a year from now. So what happens over the 5 days is not really the point. I'm just disappointed that so far it looks very weak, but it doesn't mean I'm going to change my position. It just means that it didn't right away do what I thought it would do. Anyway, So we didn't want to change everything. We just changed some stuff. So Harmony, they still exist. I think people are really underestimating them because they're still there. They didn't go bankrupt. Their model is not destroying the company. They haven't had to borrow any more money. They wanted to do another reverse split, but nobody wants to let them because people are so pissed off after the last time. So that'll end up resolving, may not resolve in our favor, but you know, they're not dead. They're just they're just not making any money. And I got some things in the mail. They seem to be tweaking their model, still tweaking their model. Apple 195 puts. All right, let's look at the things that we changed, just so we can talk about that. Apple. So we did a roll, we did a little more aggressive on Apple, blah, 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 and these Apples staying where it is, I don't know. I mean, they were all over the place. So, you know, this was here that we made this decision, and then they're zigzagging around the spot. I think this is going to hold. I think we're going to hold and come back, and coming back is going to be glorious if it happens. But like I said, that's what's killing the butterfly portfolio, because the butterfly portfolio ended up, by circumstance, ended up becoming very long on Apple as it came down. And right now we're just getting killed because the butterfly portfolio is not designed with hedges. So we have an unhedged long Apple position, and Apple is tanking. So we're just going to have to ride it out and see what happens. Here's Caesars. We decided to roll to be more aggressive on Caesars, and they're still coming down. So it's still a good trade theoretically. Here is part, why is this part 3? Oh, because part 1 didn't have anything in it in particular. No, that doesn't make any sense. Caesars. Is that right? Oh, okay. So part 1 and part 2 were like slammed together. That's why. Okay. So that was correct. So now we're on to part 3. And part 3, we talked about Frontier. We talked about, GIS just had nice earnings. So I said this one I'm worried they'll suddenly fly higher on a buyout offer. So we rolled the $40 calls to the 2000 to the 3250 calls. Nice. And blah blah blah. So basically, I said we're turning into a proper bet. That's nice. And now here we are. GIS today had their earnings and they were good. And they're up 6.5%. See how this is exactly what I said. I'm worried they're going to fly higher. I wanted to take advantage before that happened, and we did. Very happy, very pleased with that one. As I said, MO, if the market wasn't so crappy, I'd double down on them. MT, I mean, that's the problem. We're trying to conserve the cash in long-term portfolio. We've got, we don't have cash. We've got $763,000 of cash in an $852,000 portfolio. Now, of course, obviously that means this $88,000 is very, very highly leveraged. But we have it hedged in the short-term portfolio, but not well hedged enough that, because we took out the hedge in the STP, we don't really have the hedge we had before. So I'm not dying to put cash to work at the moment. Because if we put the cash to work, then we need the hedges even more, and we don't have any hedges. We have to start again. And I don't want to go down that spiral, especially I don't want to go down the spiral of adding hedges when I think the market's going to bounce. Because then all the hedges get blown out. That's been our downfall all year. As much money as we've made, we would have made a couple $100,000 more if it wasn't for all the hedges we kept buying. And I'm not saying not to hedge, obviously. I'm never going to say that. But I am saying that if I think we're at a bottom, I want to try to take advantage of it. And this is an ugly, sloppy bottom, but hopefully we'll find some footing. PZZA, I said I'd like to start looking at that as far as turning into a more proper trade. PZZA. because I think they're gonna kind of hold around a year. We'll see what happens. Didn't pull the trigger yet, but I'm looking at it. WBA. Well, what happened to them? Goldman Sachs downgraded them. Yeah, that was weird. Goldman Sachs downgraded them. We wanted them to go down, so that's fine because we have. We have these current January 75 short calls. So we have the bull call spread, which we're not worried about long term. We don't have any puts. We bought them back when it was high. And we sold the 75 short calls. So we're gonna cash in. We sold these guys for $17,000. This is only a $29,000 spread, and in one shot, only a month ago, we sold for $17,000 these 20 calls. This was part of that, when I did that set of things where I said I want to raise $100,000 selling short calls. This was one of the ones where we did it. I said, let's sell a lot of short calls to raise cash. And things like that are why we have so much cash in the portfolio. Now, all they have to do is expire worthless, and we've earned that cash. And then the next step is what? The next step would be then to take the cash and improve our WBA position, assuming we still like them long term, which I do. And then we'll sell more calls, and then we'll sell some puts, and we'll raise some more cash. It's just a cycle. We just keep following through and stick to this cycle and keep moving through it, and that's how we build our portfolios over time. And as exciting as this year has been, it's been a very good year for the portfolios. It's nothing compared to what happens as these things mature. You guys will stick with it a couple more years, and you'll see them mature. You'll see how they start turning into like freaking cash machines, just spitting out money. But it's incremental every time. It does this, we do that. When it does this, we do that. So when we think the market's toppy, we sell more calls. The market goes down. We're right. We take the call money, we put it into improving the position. Next time the market goes up, the improved position makes a ton of money. Then we sell some more calls. That's all it is. We just react to what the market does and then make adjustments accordingly. So right now, though, we've taken a big chance because in the short-term portfolio, we've effectively flipped it, if not bullish, at least neutral. And that leaves the long-term portfolio effectively unprotected. But the key to that is if the long-term portfolio was back to where it was, which was up another, probably another $100,000 from here, and the short-term portfolio is no longer bearish, we will then exceed our old record by $100,000. We'll have made a combined 10% more money on the combined portfolio, 15% more money on the combined portfolios, just by making this guess that this is going to be a bottom. If it's not a bottom, okay, we'll take a hit and we'll reposition. But I think the potential reward of making $100,000, if I'm right, versus scrambling and maybe losing $50,000, $60,000 if I'm wrong, is worth it because I feel pretty confident that this bottom should hold. What bothered me earlier, and don't forget, I was never that bearish. Is when the market was at the top, I said I expected 10% correction at least 10, at most 20. That's what I said. We're at 15 now. We're in the range I expected us to be. We're exactly made the correction I expected us to make. So I'm no longer bearish. I know people get upset because a lot of people they get used to me being bearish and they think I'm going to be bearish about all this stuff. I'm not. I'm a fundamentalist. I see where I thought the market should be, and when we were too high, I said it should be lower. When we're too low, I think it should be higher. I think we're just right here. But just right is fine because just right means this is the price that things should be at roughly. Some things, obviously not everything's the same price, but for the index wise, we're at about where we should be. And that means that if things are normal over the next year, we should go up another 5 to 10%. Over the next year after that, another 5 to 10%, providing things remain fairly normal. I don't think they're going to remain normal because Donald Trump is president, but that's beside the point. Ooh, Powell's having his press conference. This is going to be good. All right. All right, I'm going to put the sound on just because, what else we can do, right?
Since September, the U.S. economy has continued to perform well. roughly in line with our expectations. The economy has been adding jobs.
Oh, this is going to be way too boring.
The unemployment rate.
All right.
Wages have moved up for workers across.
He's doing like a backgroundy thing.
Inflation has remained.
There. All right. I'll leave it on a little bit so I can hear it. Anyway, so, it's an ebb and flow thing. It always is in the market. But the bottom line is we are now at a place where I'm pretty comfortable that the markets should be able to maintain themselves. And again, I put a lot of weighting into Apple, and I said there's no freaking way Apple should be lower than 158. And I thought 170 something, I forget the number. I thought 174 would hold, I think it was. And we've tested the very bottom for Apple. The thing I said, if it gets to 158, I would sell my house and sell my car and sell everything and cash it out and get into Apple. I mean, that's what we've done in our in the butterfly portfolio. That's effectively what we've done. We put a lot of effort of the butterfly portfolio into that Apple position. Also in the long-term portfolio, look at where we are. Minus 15,000 on these short puts. That's only part of the position. Minus 51,000 here and there. These are actually doing very well. Oh, these are the short calls. So oh, wow. Ooh, we have to buy these back. Oh, that's going to be painful. All right. Yeah, buy these back. That's silly. Holy cow. Yeah, okay. That's official. I didn't realize that. When you look, we made 70% on these calls that don't expire until 2021. What good are they doing us now? They're not doing us any good. There's no reason to keep those. And here's the cool part. See, this is the thing about selling premium, because we sold much more premium than we bought. We bought these 180 calls, and at the time, we paid $37. So we paid $217, right? I don't know what Apple was at the time. On 11/19, well, we could find out. On 11/19, Apple wasn't that far from 217. So let's say it's 207. So these things were mostly in the money. So we paid $10 premium, let's say, on them at the time. These things, though, we sold for $30, and they were all premium. 100% premium. We sold $30 worth of premium, and we bought $9 worth of premium. And they both took a hit, but since we sold less premium, we took a much less hit than they did. So we lost 51 and they lost 84. So of course we want to lock this in. It would be insane not to lock that in. They can only pay us another 36 and we've got 84 profit. Of course we're going to cash those out. If Apple goes lower, then we'll sell more calls and then we'll roll these lower and do something else. But for now, this is a no-brainer. You got to buy these back. And that goes for these too. I mean, these short June calls should be bought back. The only thing about June, though, is at least you say, well, for June, it's like, well, do I really want to spend? It's only $4,000, so I'm going to buy them back. But holy cow. That's just amazing. I'm going to say that in chat right now. Hang on a minute. Where's my thing? That's such a major thing. Home. Here it is. So let me see in the long-term portfolio. What about in the butterfly? Do we have short calls? Should we buy them back? Apple calls 95% profit. Of course we buy them back. 220 calls, 54%. That's a little more iffy, but I say buy them back. And then that would leave money talk we can't touch. Options opportunity. We don't have Apple. Okay, great. All right, well, that settles that then. All right, so let me fill this with that. In the OOP and the LTP, let's buy back. God, I can't type on this thing. All, it's too small. All short Apple calls. Okay, so again, it's part of the bottom call, but what I just realized what I was saying to you guys, I'm like, if my bottom call on the market is based on my premise that Apple can't go any lower, why on earth would we not buy back the Apple call specifically? It doesn't make any sense. So, you know, at this stage, fortunately, we're hitting this triple low on Apple. Let's buy those calls back. Okay. Burn says, I think the market is pricing in no change with everyone coming out against it. Yeah, well, maybe, but it's stupid. But again, it's like, I don't see why. It's like we already had this sell-off on whatever pessimism the Fed was going to raise, so they raised rates. Okay, fine, so there's the sell-off. But the fact that they took 2 hikes off the table next year is a very fair trade for having a hike that we should have had anyway this year. But again, my issue with the Fed is that they should have hiked two terms ago when they didn't hike. They should have hiked. Leaving it until the last minute on Christmas, I knew was going to be a disaster. It's the way they handled it. It was bad, but the hike itself is perfectly justified. Todd says, if I don't have a long Apple spread, would this be the right time to add? Sure, let's take a look at what a good Apple spread would look like. Trade. All right, I just want you guys to know this is very weird for me because usually you know, as you know, I don't like to take chances. You know, I like to be hedged, but in this particular case, there's certain times when you have to say, look, we're at a point in the market where it should bottom out. If it doesn't bottom out, I know how to recover. I know what to do. You know, it'll be painful, but we'll deal with it. But if you don't take a stand once in a while, you're never going to make really big money. I mean, and frankly, the reason we've made the money we made so far this year is because we took a stand. Because in the beginning of the year when the market tanked, we said, screw that, there's no good justification for this. And also we took a stand when the market was at the top, and I said, this is ridiculous, and we're going to start cashing out and turning more negative. That worked out too. That's why we have such ridiculous returns. We timed it well. This is, again, one of those instances, though, where I have to say, I'm sorry, I have to get more bullish here. This does not seem justified. Now, Powell is saying cross currents have emerged in the economy. Volatility has tightened. I'm reading the little summaries of the things he's been saying. But it's nothing, you know, that was the key. Now he's doing Q&A. So inflation is more subdued than expected. And then he's going to talk, but he's actually a good guy. Hal's a very smart guy. He knows what he's talking about. He's comforting, you know, whereas I don't think Yellen was comforting. I think she was competent, but she wasn't like, I think he sounds like he knows what he's doing. Gives you that air of like, you know, trust this guy, he knows what he's doing. Anyway, where were we? Spread, right, Apple. So step one, who am I talking to? I don't even know. Todd. Okay, step one, Todd. Todd, so Apple's at 164. If you're willing to own it, this is the key though. If you're willing to own it, I really have to think that selling these 150 puts for $17 is the last sale, maybe 18. You should be able to actually, 17 is the bid, so you should be able to get at least 18 for them. So selling those 150 puts for $17, $18, that nets you in for 132. All right, so 132, if you don't want Apple for 132, you shouldn't be making any kind of play on. So my attitude is to think is say to yourself, well, how much Apple am I willing to own for 132, for 150, for not 132, for 150? How much are you willing to own? So let's say you don't mind owning $30,000 worth of Apple. So that's 200 shares at 150. So then sell 2 contracts and pick up $3,600. That's your worst case, is you're going to own Apple at 150. That's not a bad case. That's a great freaking stock. You can work out the stock from there, but that's only your worst case. And it's not like you're going to lose 150 bucks per share. Let's say Apple goes to 100, you'll lose 50 bucks a share times 200 is $10,000. So you're not risking, not 10, wait, 50 times 200. All right, 50 times 200. I did some math wrong. It's $10,000. So I'm sorry, if you get 200 times 150 is 30,000. Okay, so if you sell 2 contracts, you're risking earning $30,000 worth of Apple. And if it drops to 100, you're going to be out $10,000. You're going to be out $30,000. Your risk isn't really $30,000. Your risk is what you're going to lose, and losing more than 50, losing below 100 on Apple is almost inconceivable. Could happen. I'm not saying it can't happen, but the point is, it's just like you have to say what's a realistic risk. In other words, you play football, and my risk is that I'm going to sprain my ankle or break a foot or break my arm or something like that. My risk isn't that my body is going to explode. That's the risk of going into space. It's not the risk of playing football. When people talk about risk, I notice a lot of people, when they look at options especially, they say the risk is a total wipeout. That they look at everything like it could go bankrupt and say, oh, that's your risk. You're risking this. You're not, though. You're risking what you're going to realistically lose, not what you could lose if everything falls to hell and whatever. If that happens, the world's ending anyway, so don't worry about it. And yes, any one company could go bankrupt or whatever, so you should never have more than 10% of your portfolio in the total risk. Shouldn't be. So in other words, if you don't have $300,000 and you can't afford to lose $30,000, then no, that is a risk. But if you have $300,000 and you're looking at this position and you're saying, would I own $30,000 worth of Apple? Sure, you're not going to lose. The chance of you losing more than $10,000 is negligible. But meanwhile, by selling 2 contracts, you're going to pick up. I was 150s. By selling 2 contracts, you're going to pick up $3,600. And so that $3,600 is effectively free money because you don't mind the downside of owning Apple. And I take your $3,600 and say, well, what can we buy? So at 162, you can buy, well, certainly I want to be close to the money. So these are 31. These are 35. They're not 35, though. That's bullshit because 35 is the last, but look, it's 33, 34, 60. These guys are 36. I go with that. So I'm not going to pay 31 for the 160s. When the 150s are 36, it's only $5 more for $10 better in the money. And these guys are 38.50, so I'll pay $250 to be $5 more in the money here. And these guys are, this is 38.50. So now I'm willing to pay 38.50. Now I look down to the next one and say, how much are you? You look like 41.50. So now it's $3 more here. How much are you? You're 45.50. So 38.50, 45.57. No. So here I am, 38.50. That's what I've decided now. So I like the 145s for 38.50. How much money do we have? We have $3,600 sitting around that we could spend. And how much of a spread do we want to have? Let's say if we keep it down to like 10 bucks. So let's say these guys are, what do we say, 38.50? How much is 25? All right, I don't mind that. That's so the 175. So now we got the 145, sorry, 145, 175 bull call spread is 38.50 minus 25. So that's 13.50. And how much did you sell here? You sold 3,800 bucks. So you could get 2 contracts for 26.50, and effectively you've got no cost in the trade. But your upside is $6,000. But the way I would play it is I would certainly go with at least 3. And I'd really probably go for 4. And I would just use, in other words, so by going for 4 at 13.50, you're going to spend 13.50, 27, 54, $5,400 less the $3,600 you're selling over here is $1,800 total. So you're going to spend $1,800 on 4 $30 spreads that are almost entirely in the money. So $12,000 worth of spreads for $1,800. That's the way I would go. So I would sell 2 of the 150 puts for $18, buy 4 of the 145, 175 bull call spreads at $13.50. And I believe, well, I mean, let's see, 13.50 times 4, in case I did it wrong. 1350 times 4 is 5,000. No, it's 1250. That's what. 1350 times 4, 5,400 minus 18 is 3,600. 3,600, 1,800 bucks. So that's your net in is $1,800 on the spreads. You've got Apple at 145, and you're out at 175, which is barely over where it is now. That is an incredible trade. And if it works out, you're going to get $12,000 back. So that's a nice way to you know, whatever the hell it is, 6, 7 times your money. What else did I want to say about that? Oh, and of course, since you have 4 long contracts, you could sell along the way 1 short contract because your spread is covering it. And we're at 163. So let's say that you sold just 1 January. Okay, let's say you sell 175 call for $2 and for 210 or 220. It's 220. So if you sell the January for 220, you get $220. Now that's only 30 days away. You've got 758 days to sell. So you can do this 20 times. So while collecting $220 may not seem a big deal, okay, if you do that every single month, it's 220 times 24, $5,280 more dollars in your pocket while you're waiting. You're selling a single contract. Now, you might get burned and it might go much higher on you, and so you'll take a little loss or whatever. As long as Apple doesn't pop much more than 20 bucks, it's never going to really hurt you. But you're going to collect and collect and collect, and you're selling 100% premium. So one thing you know for sure, if you are always selling 100% premium, you will get $5,280. And the question is, how many times will you get burned where it eats into your $5,280 that you're going to collect? How many times will Apple pop more than $10 in a month? And it will happen. And of course, I wouldn't do it on an earnings month. Maybe I'd skip those. You don't want to do it through earnings. But and so you wait and see what happens. But that's a nice way also, since you're only selling a quarter of what you own on the long side, you've got a pretty good cushion. You have a $12,000 upside cushion to protect you from the short calls. But obviously collecting an extra $5,000 on the spread is a well worth it effort also. So that's the way I would play it from scratch right now. All right, we're gonna have to wrap it up. That was fast. That went by quickly. It was such an exciting session. Tom says still the index has recovered a lot and then tanked again. Does that change the long haul? No, Tom, it doesn't. It doesn't change it because it's all based right now on whatever Powell says on any given second they're reacting to. And he's saying political considerations play no role in Fed policy. He's saying he's not sure about the inflation target, and he's being very sort of like, well, we'll see and whatever. He's not giving a huge positive speech because they don't know what's going on. No one knows what's going on. You got an insane person in the White House. You don't know if he's going to change his mind every 5 minutes. I'm making a call based on all the crap I see going on right now, and I think that we have now finally taken into account, and this is what I objected to in the summer when we were way too high. We did not take into account all the risks that are out there. At this point, I feel that the market has looked at all the risks a bit more closely. They see the trade war as a risk, not as some great thing happening in America. They see Trump as an insane freaking person who's going to be impeached. They see the Brexit, the European Union effectively falling apart on this Brexit crap. They see Italy for being a disaster that it is. All these things have come to light that nobody was paying attention to in the summer when I made the list of all the things I thought were like being ignored. So now that people are not ignoring them, they're now panicking and putting it in. But I think that at this point, though, a lot of that's been priced in properly, and I don't think there are any more real shocks that are going to be given out. No, that's not true. Trump actually being impeached or taken away in handcuffs or whatever they're going to do to him, that's going to shock people because even until something happens, people don't expect it, apparently. Everybody's still in denial about whether or not this president is legitimate or whatever. So they can still be shocked by that. We can still have a further sell-off, but I think where we're going to settle down is around here. All right, but certainly, wow, Powell's doing a terrible job. The Dow's now down 200 again. So whatever Powell is saying is certainly not helping, but the actions of the Fed and how it was digested, I think it's a more of a neutral sort of thing, and I think we'll settle down around here. And my call isn't based on what the market does. My call is based on where I think we are value-wise. And Alistair says, if Apple keeps dropping, could it become my call of the year for 219? Well, unfortunately, it's already IBM. So I can't take that back. But hopefully next year, we'll see if Apple stays down. How's IBM doing? I don't even know. Well, UBM is not doing anything. IBM. Nope, they're flatlining. So I made the call on Thanksgiving, so about here, and we're kind of flat from there. But again, there's another stock I didn't see a bottom to. Look, I knew where Apple was at Thanksgiving, and Apple was not my stock of the year. And you know how much I love Apple, but I thought Apple could go lower. When Thanksgiving, if they had been down here at Thanksgiving, I might have made Apple my stock of the year, but they were at 180, and from 180, I wasn't confident that we'd hold it. So my stock of the year, IBM, I was like, no freaking way. I looked at IBM down here, and I was like, this is completely ridiculous. Now, it went lower. It doesn't mean it didn't go lower, but I think this is just an insane price for IBM. And IBM was my runner-up for stock of the year a couple of years ago, didn't go with it and regretted it. So I don't regret it now. Now we're in IBM. All right. So we'll see if I'm right, but right now we are taking the risk. We are effectively long in our portfolios. We're playing for a bounce here. And it's really going to be a question on Friday when we have a very heavy data day, which I talked about in chat. Where did I talk about the data? I think that hopefully at the top of the thingy. No. What? What's going on? Durable. I did talk about the durable goods. Oh, wait, no. What's today? The 19th. Am I crazy? Or was I just talking about it with you guys? Oh, maybe I was talking about it with you guys. That's why I didn't write that in the chat. I talked about it. So Friday, we got a lot of information. So I might change my mind Friday, but at the moment, this is where I am. All right, and yeah, you're saying Merry Christmas and all that. It's like, holy crap. Wow. Yeah, I guess, wow. All right, this data is going to have to be good for me not to cover TZA on Friday. So something much better has to happen than us being down 182 points, because frankly, it's just not worth the risk, because I guess you're right. I realize that we don't have, as far as I know, for sure Tuesday's a holiday. Monday's probably a half day, but who the hell is going to be trading on Monday? So we have here, and then no one shows up here. This whole week is going to be dead. Then you got, this is a holiday. This is a holiday for sure. This is probably a half a day. Nobody's going to show up here. We have 2 weeks in the market. No one's going to show up. I'm going to be in Orlando this week with my kids. We have 2 market weeks when no one is going to be around. So I'll be working from Orlando, but I mean, this is a real holiday for us. We get to actually go and have fun. So this day, and this day, I may or may not even be here on the 31st, because it's just a silly day. I might check in the morning and get out. But we get to have an actual real holiday at Disney, so that we're going up on the weekend and we're gonna have a good time. Let's see. So yeah, so after Friday, it's just a little bit scary to leave everything open. So I imagine that I'm going to lean towards covering unless something really happens. Randy said not open on Monday. We can't be closed Monday and Tuesday. Are you saying we're open Christmas Day? That makes no sense. All right, well, let's fix this right now. Stock market holidays. They're never closed 2 days in a row. Yeah, Christmas Eve early close. We are open. Christmas Day closed. New Year's Eve. Oh, open completely? Screw you. I'm not doing it. New Year's Eve open completely. What bastards? Are they kidding? Wow. You know, China gets a whole week off. President Bush funeral. How do you put that? That's weird. I wonder when they put that. Did they put that way before he died? So next Monday we are closed at 1 p.m. I will be around for that. Christmas Day, Tuesday we're closed. The following Monday I'm in Orlando. Screw you guys. I'm taking a half. I will be working no later than when my kids get up at about 11. I know I'll let them sleep, but then we're going. And then the next day, New Year's Day, for sure we're closed, because we were closed this New Year's Day. And then we get Martin Luther King Day. This is a great time of year. You get a whole bunch of holidays. Look at this, Maundy Thursday. Look at that. My birthday's some kind of holiday. It's Maundy Thursday. I don't know what that means. I never heard of that. Randy says, wow, fake news. Everything's crashing. Oh my God, everything is crashing. Look at it. How? What the hell are you doing? Jesus Christ, man. All we had to do was get up. The market was flat. All we had to do was get up there and say, thank you very much. What is wrong with people? Follow our live coverage. So how do we do your live coverage? Live video, highlights. Two minutes, 4 minutes. Oh, here you go. Okay, here's some kind of commentary. All right, Powell takes the stage. Cross currents have emerged. After detailing its strong growth, Powell said, despite this robust economic backdrop, our expectation for healthy growth, we've seen developments that may signal some softening. Powell said global growth had moderated, although it was still solid, and that financial, this is not terrible news. These developments not fundamentally alter the outlook, as I just said, right? These developments not fundamentally alter the outlook and merely prompted most officials to modestly lower their forecast for growth next year. Seriously, this is bullshit. See, people, the problem is these trading algorithms pick out words, and if they see certain words, they freak out. And nobody gets their hands on a switch fast enough to cancel the selling orders. Fed Powell said the bank officials now think it's more likely the economy will grow in a way that calls for 2 rate increases next year. That's a shift down from the projection of 3. Powell's forecast isn't set in stone. We know the economy may not be as kind to our forecast next year as it was this year. Group said interest rates threaten to stuff out wage gains. No shit. The left-leaning Economic Policy Institute isn't happy with the Federal Reserve rate rise while hikes and blah, blah, blah. The group said it threatens to snuff out the beginning of wage. Well, then give people bigger wage gains, you idiots. Don't blame the rates. Instead of giving people 2% raises, give them 10% raises, and all of a sudden it's all fixed. Wow, ugly, ugly reaction. Powell's saying right now, most of our colleagues see the economy doing well in 2019. I'm sorry, this is wrong. Low inflation gives the Fed the ability to be patient. I said that just now before. Fed on the balance sheet, nothing to see here. Powell said the gradually winding down the balance sheet is allowing bonds to mature without replacing them. That's fine. Future rate increases have a high degree of uncertainty. That's fine. Powell defends it. Okay. Powell pushed back saying the Fed is only slightly below its goal. He said the Fed is not aiming for something below the target. We are not trying to be under 2%. We are trying to be around 2%. The Fed has not declared victory on that. Powell says political considerations play no role. Well, good, they shouldn't. Powell says shrinking balance sheet is not a disruptor. It isn't if he does it the way he's doing it, which is just simply, you know, the Fed has a balance sheet, $4.5 trillion. Most of that money is bonds. Whenever they let a bond expire, they get the cash back for the bond, which is a normal process in the bond. Nobody's being hurt by that. And they simply don't buy another bond to replace it. And that lowers their balance sheet. Then they have more cash, less bonds. That's all. There's nothing wrong with that, as long as there's some demand for the bonds. And so far, we've had very strong bond demand, which has been surprising to me. But we've had very strong bond demand so far this year. Fed's current policy stance is not meant to be restrictive, and the Fed is not heading in that direction. I don't believe it is. It might be restrictive in the future, depending on the, it might become restrictive in the future. But he's still worried about the economy overheating. And that's what he's worried about. That's not a negative. Powell says no single market is a perfect reflection of the economy, blah, blah, blah. None of this stuff is justifying what is now a 400-point sell-off. Oh my God. Wow. Wow, look at that's Apple. Oh, meanwhile, wow, there's Apple. So much for buying back those calls. Maybe we did it. Maybe because we bought back all those calls, everybody freaked out. Wow. Look at this, 2501, 2500 on the S&P. Wow, 1350. Oh, this is killing us. 23.3. This is really bad. There's no sugarcoating this. This is bad stuff, guys. Well, Merry effing Christmas. Holy cow, 400 points down on the Dow on the headline. I mean, look at it, 2,500 just failed, and not even like a look back here. That's scary. I mean, 2,500 just blew through on the S&P without a bounce. Minus 415, 420, 444, 462. This is a selling algorithm out of control. Something triggered and started selling like crazy. 483. Here we go, another 500-point down day. 469, 465. Wow, there was a fast and furious drop there for a minute. Well, still 478, 482. Nope. Come on, you can make 500. 488. Come on, 49. 490. Come on, we can do it. NASDAQ down 200 points for the day. See, in here, even 167 was 2.5% line. Don't forget the futures are not the same as the indexes. So the index is down, the NASDAQ's down 200, but this is only down, this isn't the same as the NQ. This is NAS 100, and the TVs are usually tracking the composite. But that's like, it's more than 2.5%. And when you see more than 2.5% drop in a day, you got some big problems, kid. This is nasty. But you know, look, why? Because Apple just dropped this tremendous amount. I mean, keep that in mind. Wow, look, silver went crashing down too. Apple just dropped 3.7%. So of course it's going to drag the NASDAQ down with it. And the dollar, look at the dollar shot up. And that hurts too, because the dollar was down and now it's up 0.5 point. So that shot everything down. So like I said, Friday, I think we're going to have to actually cover the TZA. I was hoping we wouldn't have to cover it at such a terrible price, but it looks like we're not going to get some good prices here. So we'll have to carefully think about what we're going to do. So tune in for the changes, and we'll see. But yeah, it's kind of risky because you're talking about there's really nothing we're going to be able to do on Monday and Tuesday. It's going to be 2 dead days. The whole week's going to be dead. Then we're into 2 more holiday days. It's going to be very ugly trying to it's going to be very ugly trying to figure out like how to really balance out the portfolio. And it's very data dependent on Friday morning. So Friday morning is going to be key. All right. And I wish I had a better, clearer thing for you guys, but this is surprising me. I think this is wrong. If we reverse, great, but I think this is just crazy sell-off. But I certainly don't have the balls to take a long here. We said before we were going to go long up here, now we're down here. So I mean, this is, you can't play this market. It's ridiculous. So Brian says covering TZ. I'm still gonna wait till Friday. We'll see what happens. I mean, it's not. I mean, look, the worst thing that's going to happen, which is a bad thing, but we're going to lose 5-10% of our portfolios if we're wrong about the covering. And if we weren't up so much for the year, I would be a lot more worried about it. But we're losing some of what we're up. But I think this is just way overdone. I think some computer program triggered and got out of control, and I think all this is nonsense. But we're not going to know until Friday whether or not that's true. All right, so we'll see where we are then. All right, well, thanks for coming, everybody. And I'm sorry it wasn't more fun, but it's a little bit scary today. We'll see what happens. And oh, wait, next week. Next week is, I have no reason not to do this on Wednesday next week. I'm going to be around. So I think we're going to do it next week. Okay, thanks.